Guys, welcome back to my channel. In this video we are going to be looking at this ICT concept of fair value gaps. Many of you have been requesting that I make videos on how to identify fair value gaps. This is a very one of the most dreaded ICT concept where we'll be able to explore how to catch very high winning opportunities like this in the market, forex market, indices, or whatever you're trading. All right. In this video we are going to be looking at it, introducing this concept of smart money, the fair value gaps, what is a fair value gap, the psychology behind fair value gap. I will show you guys how to draw them properly in your chart, and then most importantly how you can trade these fair value gaps. All right, so if you like seeing videos like this, or if you're interested in ICT concept as SMCs, then you want to subscribe to this channel by hitting on the subscribe button and notification bell. Also give me a like. All right, make sure you watch the video till the end.
I am Full Kingsley. By the grace of God, I bring to you guys strategies, tutorials on the forex market, volatility indices, metals like gold, Nasdaq, VIX75, many other instruments. You want to subscribe to the channel by hitting on the subscribe button and notification bell to not miss out.
A fair value gap will be formed in the market where supply exceeds demand, or in a situation where demand exceedingly exceeds supply, right? In this kind of situation, there is what we call an imbalance. The number of buyers that are available, or the volume of buy trades that are available are huge, are too much. They outweigh the sell trades, right? While in the other hand, if it is the other side round, the number of sell trades will exceed the number of buy trades, so the volume will be too high, which price will create behind an imbalance. And this imbalance will usually leave behind what? Very huge bodied candlesticks like this, very big bodied candlestick like this. In a buy situation, you see a situation like this. In a sell situation, you see something like this. That's why you are able to see price leave behind imbalance, and then you are able to exploit it. All right, so that's why you are going to see that this is how price will usually tend to move after price comes back and create an imbalance. Now you realize that in a situation where we have a very big body candle like this, for instance, this is a situation where buyers just came in, right? We have the institution that executes very huge trades and create behind very strong candlestick moves, right? All right, just like this candlestick, as you can see here, this is a very big huge body candlestick, and when this happens, it's a sign that the buyers, the number of buys have exceeded in a significant portion. So with this, you see a very big body candle. What happened at the end of the day? It leaves behind an imbalance, right? Now, how do we identify imbalance using our candlesticks? Right now, we look at what? Huge momentum in the market. That's what you should identify, right? You look at huge momentum in situation where we have very strong bodied candlestick, right? Like this situation here. Okay, now let's come back to this initial example, and then let me just plot it out afresh. Now if you look at this situation, you are going to see that between these candlesticks here, from this low right up to this high here, right, all of this zone here, okay, we have this particular imbalance here where price has actually created space. This is a strong bodied candlestick, right? So this strong bodied candlestick actually leaves behind what? Space. In a sequence of 3 successive candles, one candle leaves behind space. That is the candle that was formed. This is the first, second, and the third candle, right? So the bigger candle is in the middle, meaning that the candle that was formed before and after that, they are not able to overlap. So meaning that the top of this candlestick and the bottom of the third candlestick do not touch. That is what we call an imbalance. So here, this is the candlestick that was first formed before this big candlestick, and then the candlestick that was formed after this big candlestick. So you plot from the top of this candlestick right to the bottom of the third candlestick, and then you drag. All right, that is how an imbalance is identified. So you look at the massive body candle, you look at the candle that was formed before and after, you look at what? The top of the wick and then the bottom of the wick, you plot it out like that. This is the fair value gap. In this situation, you want to wait for price to pull back to this zone, and then you want to be looking to take your buy trades, right? So like I said, the psychology behind this is because the buyers at this point exceeded the sellers, and we had the banks execute trades, and then we have very strong moves. Now if you look at this, you are going to see that, okay, as price pulls back now, price has created another imbalance, right? Let's just cancel this and then try to draw again. Now if you look at this swing from here to here, right, we can identify about 3 imbalances, right? So now number one, you look at what the huge body candlestick, which candlestick has a lot of momentum, right? You can identify this, you can identify this, right, this to an extent. All right, now how do we draw this imbalance? You look at the huge body candlestick. What happened? You look at the candlestick that was formed before and after. So this is the candle that was formed before and after. Now, has the wick of this candlestick touched the wick of this third candlestick? No, it has give us what, an imbalance. So you plot from what, the wick of this first candlestick that was formed to the wick of the third candlestick, and then you drag. That is the imbalance here. Now another a constant thing you need to understand about this, the psychology, is also that if this happens and this candlestick does not come, these two candlestick does not touch, it means that what, this zone has not yet been mitigated. Meaning if you go to a smaller time frame, you are not going to see a candlestick that has come down and closed before going up, right? Mitigation here will simply means that if you go to a smaller time frame, price would have come down like this before going up. That's the meaning of mitigation. But if there is a space between this candle, this first candle, and this last, it means that in a smaller time frame, price did not come to mitigate like this before going up, but you instead mean that price has not yet mitigated this one, so it has gone like this and it has come back, and then it has left behind what, space here, right? So that is the meaning, and that's the psychology behind this. So that's why we identify this space. Now if you look at it, we have another imbalance up here, right, between this candlestick and this. Now this is a huge bodied candlestick. The wick of this candle to the wick of that candle here, it has left behind what, an imbalance. If you look up here, you're going to see we have the same thing, a very strong bodied candle. What happened? The wick between this wick, I mean the wick of the first candle that was formed and the wick of the third candle that was formed after the huge candle, this is the imbalance here, right? So in this situation, we have a possibility that price can either move from this zone, from this, and from this. Now I will share with you guys how to identify the best quality imbalances, right? Now if you look at gold, for instance, you are going to see here we had gold. After gold started, moving down, rallying downwards, what happened? Gold actually left behind this imbalance here, right? I've already explained. You can see this is the huge body candle around this swing here. We have two huge body candles, this and this, right? And this has actually left behind what, an imbalance, because the candlestick that was formed before and after, it has left behind space. So we are expecting price to pull back to this zone here, and that is how we will usually place what, our sell positions, right? We'll put our sell positions there when we identify it, and then our stop loss above, we want to be targeting this zone below here. But now, how do you identify good imbalances to trade, right? Ensure that before price gets to an imbalance, we have had what, equal lows that have been created. This is a typical example, or equal highs, right? In this situation, price has rejected a couple of times, right, leaving behind liquidity. Always ensure that there is a liquidity pool before an imbalance, right? Meaning that price has created equal highs here. When price creates an equal high, what happened? It always leave behind liquidity, because in this situation, retail traders are going to be selling, waiting for price to come back here. They sell, they wait for price to come back to sell. So we have a lot of stop losses above there. Those stop losses will be there before price gets to the imbalance. Now the reason why we do not consider the other imbalance, this imbalance here, is because of the fact that price had not properly tapped or had not created a good liquidity zone like this, right? And it is the first imbalance, right? So one of the things you should do is you identify the imbalance that is furthest away from price, because the first imbalance could be used as liquidity, because people will be entering earlier, they will have their stop loss. And remember, we are dealing with the banks. The banks will need people when they want to sell. They will ensure that they induce other people to enter earlier, and they get stopped out before they can take their trades because of the huge volume. So they will always need liquidity, that so that price can be able to move. That is also the psychology behind this. So you see, once you have identified an imbalance and you realize that there is a liquidity zone before this imbalance here, right, meaning that here people place stop loss, instead enter based on the imbalance above, right? And then you place your stop loss, and let's see how price plays out. Okay, you can see that price executes the imbalance, right? It has actually gotten executed, and you see that price drops powerfully, right? Now the reason why this imbalance was very good is because price had actually cleared liquidity before reaching here, right? Because here we had many people who were looking to be selling. Many people sold, many people sold, many people sold, many people sold, and others were selling. And so we had stop losses. When the banks clear all of these stop losses here, there will be enough liquidity, because liquidity is like fuel that moves price. So when there's enough liquidity before an imbalance, it taps, price usually drop. So that's how you should identify high probability imbalances. Now coming back to this example here, right, we can have this imbalance here to be the highest probability imbalance, because these ones could be used as liquidity. Nevertheless, this can also work, it can also work out. But when you are entering based on the first imbalances, always ensure that you don't risk, you divide your risks. If you are risking initially maybe 2%, you can divide your risks and your risks maybe 0.5 or 1%, right? Make sure you risk more when the imbalance is furthest away, and also when you see a build up that creates maybe a liquidity scenario before you should be entering, right? So it could come and then maybe reject, and then when it taps here, sometimes see that it moves because it has already cleared liquidity. Always pay attention to that, right? So we have talked on how to identify imbalance, we have talked on the psychology behind imbalance, what imbalances are, and then how you can plot them and how you can trade them, right? So we are going to be bringing more explicit videos, right? If you always want to continue seeing content like this, give me a thumbs up, and also make sure you comment on this comment section below. If it's your first time coming across the channel, make sure you subscribe by hitting on the subscribe button and notification bell so that you don't miss out on anything. See you in the next video.